When I first started trading, I was like most people. I thought success meant finding the perfect strategy, the secret indicator, or the magical pattern that would unlock instant profits. I spent months jumping from one YouTube tutorial to the next, buying courses and testing every single trading system I could find. My account balance looked like a roller coaster that only went down. I was frustrated, exhausted, and honestly ready to quit. But then something clicked. After nearly 2 years of struggling, losing money, and questioning whether I was cut out for this, I realized I wasn't failing because of bad strategies or market conditions. I was failing because I was approaching trading completely wrong. The breakthrough didn't come from finding a better system. It came from changing four fundamental things about how I thought about and executed trades. These four changes didn't just improve my results, they completely transformed my relationship with the market. Trading went from being a constant source of stress and confusion to feeling almost mechanical. Not boring, but predictable in the best possible way. My win rate improved, my losses became smaller, and most importantly, I stopped second guessing every decision I made. In this video, I'm going to walk you through exactly what these four changes were and how you can implement them in your own trading. By the end, you'll understand why most traders struggle for years without making real progress and how you can shortcut that entire process. I wish someone had told me these things when I started because it would have saved me thousands of dollars and countless sleepless nights. But before we dive in, let me be clear about something. These aren't quick fixes or magic bullets. They're fundamental shifts in thinking that require discipline to implement. However, once you truly internalize them, they become automatic. You won't have to think about them anymore. They'll just be part of how you approach every single trade. The first thing that changed everything for me was learning to think like a business owner instead of a gambler. When I started trading, every single position felt like a bet. I would put money on the line and hope the market moved in my direction. If it did, I felt like a genius. If it didn't, I felt defeated. This emotional roller coaster was exhausting and it was costing me money. The shift happened when I started viewing each trade as just one transaction in a long series of business operations. Imagine you own a restaurant. Not every meal you serve will be perfect. Some customers might not like what they ordered. You might have to throw away food that's spoiled. But you don't close the restaurant because of one bad day or one unhappy customer. You understand that over time, if you serve good food and provide good service, the business will be profitable. Trading works exactly the same way. When you think like a business owner, you stop caring about individual trades and start caring about your overall performance over time. This mental shift eliminates the emotional attachment that destroys most traders. You're no longer gambling on each position. You're executing a business plan. This mindset change affects everything. When a trade goes against you, it's not personal failure. It's just a cost of doing business like rent or utilities. When a trade goes in your favor, it's not because you're brilliant. It's because you executed your plan correctly. This emotional detachment is incredibly powerful because it allows you to make decisions based on logic instead of fear or greed. The second change was developing what I call systematic patience. Most traders, myself included when I started, feel pressure to always be in a trade. The market is moving, opportunities seem to be everywhere, and sitting on the sidelines feels like missing out. This leads to forcing trades that don't meet your criteria, which almost always results in losses. I learned that the market rewards those who wait for the right opportunities, not those who trade the most. Think about a lion hunting. It doesn't chase every animal it sees. It waits, watches, and strikes only when the conditions are perfect. That's systematic patience in action. For me, this meant creating a strict checklist of conditions that had to be met before I would even consider entering a trade. Market structure, price action, volume, risk-reward ratio, economic calendar events, everything had to align. If even one element was missing, I would pass on the trade no matter how tempting it looked. This was difficult at first because it meant watching potential opportunities go by, but I quickly realized that passing on mediocre setups allowed me to focus entirely on the exceptional ones. My win rate improved dramatically, and more importantly, my losing trades became much smaller because I was only entering when I had a high conviction. The patience extends beyond just entry points. It applies to holding positions, waiting for profit targets, and accepting that some days or even weeks might pass without any trades at all. The market doesn't operate on your schedule. Your job is to be ready when it presents genuine opportunities. The third transformation was learning to manage risk, like my life depended on it. Early on, I treated position sizing casually. I might risk 2% on one trade, 5% on another, and sometimes even 10% on trades I felt really confident about. This inconsistency was slowly bleeding my account dry. The change came when I implemented a rigid risk management system that I never deviated from. Every single trade would risk exactly the same percentage of my account. No exceptions. No matter how confident I felt, no matter how perfect the setup looked, I would never risk more than my predetermined amount. This consistency in risk management had an unexpected psychological benefit. It removed the temptation to revenge trade after losses. When you lose a fixed small percentage of your account, the urge to immediately make it back by taking bigger risks is much weaker. You can think clearly about the next opportunity instead of being driven by emotions. I also started tracking my risk-reward ratios religiously. Before entering any trade, I would identify exactly where I would exit if I was wrong and exactly where I would take profits if I were right. The potential reward had to be at least twice the potential risk, and preferably 3 times. This simple rule meant that even if I was wrong more often than I was right, I would still be profitable over time. Risk management isn't just about individual trades either. I learned to think about portfolio risk, correlation between positions, and how much of my total capital I was willing to have at risk across all open trades simultaneously. This broader view of risk helped me avoid the trap of having multiple losing positions in related markets, all moving against me at once. The fourth and final change was developing complete emotional independence from short-term results. This was perhaps the most difficult shift to make because it goes against human nature. We're wired to feel good when we win and bad when we lose. In trading, this natural response can be devastating. I had to train myself to measure success differently. Instead of focusing on whether my last trade was profitable, I started evaluating whether I followed my process correctly. Did I wait for the right setup? Did I enter at the planned price? Did I manage risk according to my rules? Did I exit where I said I would? When I could answer yes to all these questions, the trade was a success regardless of the financial outcome. This shift in how I defined winning completely changed my emotional relationship with trading. I was no longer at the mercy of market movements. My confidence came from executing my plan, not from making money on every trade. This emotional independence also affected my decision-making during trades. I stopped checking my profit and loss constantly. I stopped moving stop losses because I didn't want to take a loss. I stopped closing profitable trades early because I was afraid of giving back gains. The predetermined plan became sacred, and I followed it regardless of what my emotions were telling me. The psychological freedom that comes from this mindset is incredible. You stop living and dying with every market tick. You stop refreshing your account balance every few minutes. You stop losing sleep over positions because you know you've planned for every scenario. Your emotions become completely divorced from short-term market movements, which allows you to see opportunities and threats with crystal clarity. But here's what most traders don't realize about emotional independence. It's not something that happens overnight. It's a skill that has to be developed through repetition and discipline. Every time you follow your plan despite wanting to deviate, you're strengthening this mental muscle. Every time you take a planned loss without anger or revenge trading, you're building the foundation for long-term success. I remember the exact moment I knew these changes had taken root. I was in a trade that was moving against me. The old version of me would have been staring at the screen, moving my stop loss, hoping and praying for a reversal. Instead, I was calm. I knew my exit point, I knew my risk, and I was prepared to take the loss if needed. When the price hit my stop, I closed the position without hesitation and immediately started looking for the next high probability setup. That's when I realized trading had become mechanical in the best possible way. Now, let me be brutally honest about implementing these changes. The first few weeks are going to feel uncomfortable. Your brain is going to fight against this new way of thinking. You'll be tempted to take trades that don't meet your criteria because they look so appealing. You'll want to risk more on setups you feel confident about. You'll want to hold losers longer and cut winners shorter because that's what feels natural. This is where most traders fail. They understand these concepts intellectually, but they can't maintain the discipline required to implement them consistently. They'll follow the rules for a few days or maybe a week, and then they'll make an exception. One exception becomes two, two becomes 10, and before they know it, they're right back where they started. The key is to start small and build these habits gradually. Don't try to implement all 4 changes at once. Pick one, maybe the business owner mindset, and focus on that for an entire month. Every single day, remind yourself that you're running a business, not gambling. Write it down, say it out loud, whatever it takes to reinforce this new way of thinking. Once that mindset becomes automatic, add the systematic patience. Force yourself to wait for perfect setups, even if it means going days without trading. Use that time to study charts, refine your strategy, or work on other aspects of your trading business. Remember, not trading is also a trading decision, and sometimes it's the most profitable decision you can make. The risk management piece should actually be the easiest to implement because it's purely mechanical. Decide on your position size before you enter any trade and stick to it no matter what. Use position sizing calculators, set up your trading platform to automatically calculate your risk. Do whatever it takes to remove emotion from this decision. The emotional independence will naturally develop as you master the other 3 areas. When you're thinking like a business owner, waiting for the right setups and managing risk properly, the pressure on individual trades disappears. You're no longer depending on any single position to make or break your account. I want to share something that happened about 6 months after I implemented these changes. I was having what most traders would consider a terrible week. 4 trades in a row had hit their stop losses. The old me would have been devastated. Probably would have started revenge trading or increasing position sizes to try to make the money back quickly. Instead, I looked at my trading journal and realized something remarkable. Even with 4 consecutive losses, I was only down about 3% for the week because my risk management was so strict. More importantly, I had followed my plan perfectly on every single trade. The setups were valid, my entries were precise, and my exits were exactly where they should have been. This wasn't a bad week. This was exactly how trading is supposed to work sometimes. The market had presented me with what looked like good opportunities. I had executed my business plan correctly, and the results just happened to go against me. No emotion, no drama, no desperate attempts to force profits. Just business as usual. That's when I truly understood the power of these 4 changes. They don't guarantee that you'll win every trade or even every week. What they guarantee is that you'll be able to survive the inevitable losing streaks and position yourself to capitalize when the market does move in your favor. The compound effect of these changes is extraordinary. Better entries lead to better risk-reward ratios. Better risk management preserves capital during drawdowns. Emotional stability prevents the costly mistakes that wipe out accounts. And the business mindset ties it all together by keeping you focused on long-term profitability instead of short-term validation. Think about this for a moment. Most traders spend years searching for the perfect strategy, the secret indicator, or the hidden pattern that will finally make them profitable. They're looking for the holy grail in all the wrong places. The real holy grail isn't a strategy at all. It's a mindset. It's a systematic approach to decision making that can be applied to any market, any time frame, and any trading style. These 4 changes work whether you're trading stocks, forex, futures, or cryptocurrencies. They work whether you're a day trader, swing trader, or long-term investor. They work because they address the fundamental human behaviors that cause most people to fail in the markets. But here's where things get really interesting. Once these 4 pillars become second nature, something unexpected happens. You start seeing the market differently. Patterns that used to confuse you become clear. Setups that used to make you nervous become routine. And most importantly, you develop what I call market intuition. This isn't some mystical ability to predict the future. It's simply the result of approaching trading with a consistent framework for so long that you begin to recognize subtle cues in relationships that less disciplined traders miss. Your brain stops being clouded by hope, fear, and excitement, which allows you to process information more objectively. For example, I started noticing how certain price movements during specific market conditions almost always led to predictable outcomes. Not because I had some special insight, but because I wasn't emotionally invested in being right. I could observe the market's behavior without needing it to validate my opinions or rescue my account from previous losses. This clarity extends beyond just reading charts. You begin to understand market psychology in a deeper way. You can sense when other traders are getting emotional, when they're panicking, when they're becoming overconfident. And since you're no longer driven by those same emotions, you can often position yourself to benefit from their predictable reactions. I remember one particular trading session about 8 months into this new approach. The market had been trending strongly for several days, and suddenly there was a sharp reversal. My screens lit up with what looked like incredible buying opportunities. Prices were falling fast, and every fiber of my being wanted to jump in and catch what appeared to be a massive discount. But something felt off. The volume was wrong. The speed of the move was too aggressive. Most importantly, none of the setups met my strict criteria despite looking superficially attractive. So I did nothing. I watched thousands of dollars in potential profits disappear as prices continued falling. 3 hours later, the market collapsed even further. What had looked like a buying opportunity was actually the beginning of a much larger decline. Traders who had jumped in during that first wave of selling got crushed. Meanwhile, I was sitting comfortably in cash, waiting for genuine opportunity to present itself. That's the power of systematic thinking. It protects you from your own instincts when those instincts would lead you astray. It keeps you disciplined when discipline is the last thing you want to maintain. And it positions you to capitalize on the mistakes that less prepared traders inevitably make. The transformation doesn't stop there, though. As your trading improves and becomes more consistent, you start to notice changes in other areas of your life. The patience you develop in the markets carries over to business decisions, relationships, and long-term planning. The emotional control you build helps you handle stress and pressure in ways you never could before. Risk management becomes second nature, not just in trading, but in how you approach major life decisions. You naturally start thinking about potential downsides before getting excited about potential upsides. You become more comfortable with uncertainty because you've learned to plan for multiple scenarios instead of hoping for the best outcome. Most importantly, you develop genuine confidence. Not the fake confidence that comes from a few lucky trades, but the deep, unshakable confidence that comes from knowing you have a proven process that works over time. This confidence shows up in how you carry yourself, how you make decisions, and how you handle setbacks both in trading and in life. But let me address something that might be bothering you right now. You might be thinking that this all sounds too good to be true, or that maybe these changes worked for me because of some special circumstance or natural talent. I understand that skepticism because I felt the same way when other traders tried to share similar insights with me early in my journey. The truth is, there's nothing special about me as a trader. I don't have some innate ability to read charts or predict market movements. I'm not particularly smart or talented when it comes to financial markets. What I did have was the willingness to admit that my original approach was completely wrong, and the discipline to stick with a new approach, even when it felt uncomfortable. That willingness to change and that discipline to persist are the only special qualities required. Everything else can be learned, practiced, and improved over time. The market doesn't care about your background, your education, or your natural abilities. It only cares about whether you can make good decisions consistently under pressure. I've seen traders with advanced degrees in finance fail miserably because they couldn't control their emotions. I've seen high school dropouts become incredibly successful because they followed simple rules with unwavering discipline. The market is the ultimate equalizer in that regard. It rewards the right behaviors regardless of who's exhibiting them. The fourth change I mentioned, developing emotional independence, is probably the most misunderstood aspect of successful trading. Many people interpret this as becoming cold or robotic, as if you need to eliminate all feeling from your trading. That's not what I'm suggesting at all. What I'm talking about is separating your self-worth and emotional state from your trading results. You can still feel satisfaction when a trade works out well, and you can still feel disappointed when one doesn't. The difference is that these emotions don't drive your next decision. They don't cause you to deviate from your plan or make impulsive choices. Think of it like being a surgeon. A good surgeon cares deeply about their patients and wants every operation to be successful. But they don't let their emotional attachment to the outcome affect their technique during the procedure. They follow established protocols, make decisions based on their training and experience, and maintain steady hands regardless of how they feel about the situation. Successful trading requires the same kind of professional detachment. You care about the results, but you don't let caring about the results compromise your execution. This balance takes time to develop, but it's absolutely essential for long-term success. One thing that really accelerated my development in this area was keeping a detailed trading journal. Not just recording wins and losses, but documenting my thought process before, during, and after each trade. What was I feeling when I entered? Did I stick to my plan? If not, why did I deviate? How did I handle the outcome emotionally? This kind of honest self-reflection reveals patterns in your behavior that you might not notice otherwise. Maybe you tend to get overconfident after a series of wins. Maybe you become too conservative after losses. Maybe you trade differently on Fridays than you do on Mondays. These insights are incredibly valuable because they help you recognize when your emotions might be influencing your decisions. The journal also serves as a reality check during difficult periods. When you're going through a losing streak and starting to doubt whether your approach actually works, you can look back at previous similar periods and see how they resolved. You can remind yourself of all the times you wanted to abandon your plan but stuck with it and eventually saw positive results. Over time, this documentation becomes a powerful tool for building confidence in your process. You start to see that your approach works not because it wins every time, but because it manages risk effectively and positions you to capitalize on favorable opportunities when they arise. Another crucial aspect of this transformation is learning to view losses as tuition payments rather than failures. Every losing trade teaches you something valuable if you're paying attention. Maybe it shows you a flaw in your analysis. Maybe it reveals a gap in your risk management. Maybe it highlights an emotional trigger you didn't know you had. The most successful traders I know have all lost significant amounts of money at some point in their careers, but they treated those losses as expensive education rather than reasons to quit. They studied what went wrong, adjusted their approach, and came back stronger and smarter. This mindset shift is particularly important for new traders who might be dealing with their first major losing streak. It's natural to question everything when trades aren't going your way. The key is to question your execution and your discipline, not necessarily your entire approach. If you're following a proven methodology but getting poor results, the problem is usually in the implementation, not the strategy itself. I want to share one more story that really illustrates how these changes compound over time. About a year after implementing these 4 principles, I found myself in the middle of what became my longest losing streak as a trader. 12 consecutive trades hit their stop losses over the course of 3 weeks. The financial impact was manageable because of strict risk management, but the psychological challenge was enormous. Every day I sat down to trade, a voice in my head whispered that maybe I'd lost my edge, maybe the market had changed, maybe I should try a different approach. But I had a year of evidence that my process worked when executed properly. I had detailed records showing that losing streaks were a normal part of trading and that they were usually followed by periods of strong performance. Most importantly, I had developed the emotional resilience to weather temporary setbacks without making permanent changes. So, I continued following my plan exactly as written. I waited for the right setups, managed risk appropriately, and executed each trade with the same discipline I'd maintained during profitable periods. On the 13th trade, I finally had a winner, then another, then 3 more in a row. By the end of the month, I had not only recovered all the losses from the streak, but had actually finished ahead of where I started. More importantly, I had proven to myself that the psychological transformation was complete. I could handle adversity without falling apart, stick to my plan under pressure, and maintain confidence in my process even when short-term results suggested otherwise. That experience taught me that these 4 changes don't just make you a better trader. They make you anti-fragile. Instead of being damaged by stress and setbacks, you actually become stronger because of them. Each challenge you overcome builds more confidence in your ability to handle whatever the market throws at you next. The beautiful thing about this approach is that it's completely scalable. Whether you're trading with $100 or $100,000, the principles remain exactly the same. The only thing that changes is the number of zeros on your position sizes. Your mindset, your discipline, your risk management, and your emotional control work the same way regardless of account size. This scalability is crucial because many traders struggle when they try to increase their position sizes. They've been successful with small amounts, but when they start trading larger positions, they fall apart emotionally. The money becomes too real, the pressure becomes too intense, and they abandon the very approach that made them successful in the first place. When you've truly internalized these four changes, scaling up becomes natural and stress-free. You're not thinking about the dollar amounts at risk because you're thinking in terms of percentages. You're not worried about individual trade outcomes because you're focused on long-term process execution. The psychological pressure that destroys most traders simply doesn't exist anymore. This is why I believe most trading education completely misses the point. Everyone wants to teach you about indicators and chart patterns and market structure. Those things matter, but they're not what separates successful traders from the 90% who fail. What separates them is the ability to execute a simple plan consistently without letting emotions sabotage the process. The market is essentially a psychological battlefield where your biggest enemy isn't other traders or institutional players. It's your own brain. Your brain is wired for survival in a world that existed thousands of years ago, not for making rational decisions in financial markets. It wants immediate gratification. It fears loss more than it values gain, and it looks for patterns even when none exist. Every successful trader has learned to work with their psychology instead of fighting against it. They've accepted that they'll never eliminate emotions completely, so they've built systems that account for human nature. They've created rules that protect them from themselves during moments of weakness or overconfidence. This is something I wish I'd understood earlier in my trading career. I spent so much time trying to find the perfect entry technique or the most accurate indicator. I thought if I could just predict market movements with enough precision, everything else would fall into place. What I didn't realize is that even if you could predict the market correctly 80% of the time, you still lose money if you couldn't manage your emotions and risk properly. I've seen this play out countless times with other traders. They'll have incredible analytical skills and spot amazing setups, but they'll risk too much on individual trades or hold losers too long or cut winners too short. Their technical analysis might be world-class, but their execution is amateur level because they never addressed the psychological side of trading. The irony is that once you get the psychology right, the technical side becomes much easier to learn and apply. When you're not emotionally attached to being right, you can see market movements more objectively. When you're not desperate for profits, you can wait patiently for the best opportunities. When you're not afraid of losses, you can cut bad trades quickly and let good ones run. This creates a positive feedback loop that accelerates your development as a trader. Better psychology leads to better execution, which leads to better results, which builds more confidence in your process, which improves your psychology even further. It's the complete opposite of the negative spiral that traps most struggling traders. But here's what really changed my perspective on trading and life in general. These four shifts taught me that success in any field comes down to the same fundamental principles. Whether you're building a business, developing relationships, pursuing fitness goals, or mastering any skill, the same psychology applies. You need to think long-term instead of seeking instant gratification. You need patience to wait for the right opportunities instead of forcing mediocre ones. You need discipline to stick to proven processes even when they're uncomfortable. And you need emotional resilience to handle setbacks without abandoning your approach. Trading became my laboratory for developing these life skills because the feedback is so immediate and honest. The market tells you within minutes or hours whether your decisions were good or bad. There's no way to fake it or make excuses. Either you followed your plan or you didn't. Either you managed risk properly or you didn't. Either you controlled your emotions or you didn't. This brutal honesty is actually a gift because it forces you to confront your weaknesses and develop real solutions. In other areas of life, you might be able to rationalize poor decisions or blame external factors. In trading, the numbers don't lie. Your account balance is a direct reflection of your decision-making quality over time. The skills you develop to become a consistent trader translate directly to becoming more effective in other areas. The patience you build waiting for perfect setups helps you make better business decisions. The risk management mindset helps you evaluate major life choices more carefully. The emotional control helps you handle stress and pressure in any situation. Looking back at my journey, these 4 changes didn't just transform my trading results. They rebuilt my entire relationship with uncertainty, discipline, and long-term thinking. The business owner mindset, systematic patience, ruthless risk management, and emotional independence work together like compound interest. Each reinforces the others until following your plan becomes as natural as breathing. If you're struggling with consistency, start with just one of these shifts. Master it completely before moving to the next. The market will always be there, but your opportunity to develop unshakable discipline starts right now. Your future self will thank you for making these changes today.